was the right move because that's what I wanted to happen last year when I saw you. I think what's happened is that the global economy has come almost to a full stop. So my base case right now is that 2015, only one quarter old, but I think is already lost in terms of growth for Australia, but also the world. China has significantly underperformed on growth, certainly also in PMIs, reflected in iron ore prices and all the resources around the world. We have the US starting the year looking like they were going to take off. At least that was the very naive expectation of the marketplace. Now, one quarter in again, it's been reduced in terms of earnings potential, and certainly growth even from the Federal Reserve has been reduced. So the world have two growth engines in a simple model. One is the US slowing down. The other one is emerging market led by China slowing down. In the middle sits, of course, Europe. Europe is marginally improving, but its contribution to global growth is almost zero because we are coming from recession into +0.5%, +1%. It's still very good because it's a very powerful and big economy, but it's too slow to being able to offset the negativity of the negative surprise to upside in the US and a much bigger downside in China. And I think for your investors, I think what we're dealing with here is that we will make new low in 2015 in terms of economic cycle, but the market full impact will come in 2016 because I firmly believe that the real market leads the stock market by 6 months. And I think what's been going on in Australia, low interest rate, almost 200 basis points down on 1 year ago. You have energy prices halved, and you have the fact that the Aussie dollar is down a good 20% overall. The full impact of that, the improvement to the terms of trade, to the improvement to the net consumer in Australia is starting to happen now. The recent Westpac PMI numbers was very constructive, moving from negativity to positive implementation forward. I think productivity in Australia is finally coming online again, where we move from investment cycle to production cycle. So I think at the margin, a lot of things are improving, but the pure momentum of the negativity will make almost certain that Australia, is going to flirt with very low growth rates, even close to recession. I think it's a 50-50 on recession. But the point is, 2015 is going to be the low for the cycle. Then we're going to have margin improvement in 16, and then in 17 China will pick up again because this recent initiative called the Silk Road, which is the China stepping in with a Marshall Plan for all of Eurasia, is going to come fully online in 2015. It was just remarkably made priority number 1 in the recent China National Congress. So I think a lot of things is happening underneath a very quiet market where people are just chasing yield. But I think the worst place to be the next 6 to 9 months is chasing yield in bank stocks, while you see fundamental value in mining and in construction company, and certainly in the real economy.